Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. A market civil war erupts after the Fed rate cut. While the Nasdaq inches higher, small caps quietly surge to a record high, signaling a massive capital shift. Is this the great rotation everyone's been waiting for? Second, crisis at the Fed. A historic internal war erupts over rate cuts, shattering a 6-year consensus. This three-way battle signals rising chaos and a major policy mistake could be looming. What does this mean for your portfolio's safety? Finally, Nvidia's H100 chip ignites an orbital arms race. For the first time, a powerful AI is running in space, triggering a geopolitical showdown. As China and the US battle for data dominance, is a new Cold War starting in the stars? Warning, the Fed has just cut rates again, but the market is sending mixed signals. The S&P 500 closed flat, but listen closely, the real story is the divergence across indices. The tech-heavy Nasdaq gained 0.1%, buoyed by growth in AI stocks, while the Dow slid 0.3% due to financial sector woes. It's a tale of two markets, and your strategy must adapt quickly. Here's the backdrop. The Federal Reserve's 25 basis point cut marks their third consecutive reduction this year, bringing the target range to 3.50% to 3.75%. However, the Fed's guidance suggests this might be the end of the easing cycle, with only one more cut expected in 2026. This shift has investors recalibrating their positions, especially in tech and small cap stocks. The Russell 2000 hit a record high, indicating that small caps are benefiting from lower rates and cyclical recovery bets. Let's dig deeper. The Fed's decision is a double-edged sword. On the policy front, the cut aims to support the economy against inflationary pressures, which remain stubbornly high. However, the Fed's internal dissent, two members wanted no change, and one sought a larger cut, reveals uncertainties about inflation and growth. Money flows are telling. While tech stocks like Nvidia, which trades around $190 after strong earnings, are seeing inflows, financials are hurting. JP Morgan, down 4.7%, faces headwinds from rising expenses, signaling potential margin compression. Valuation is the next puzzle. The Nasdaq's rally suggests optimism, but beware, tech valuations are stretched. Nvidia's earnings underscore AI's growth potential, yet its lofty multiples could face pressure if rate expectations shift. Meanwhile, the Russell 2000's ascent signifies a bet on economic recovery, but small caps could be vulnerable if growth falters. Here's the strategy. I'm telling you, it's time to act. Trim your mega cap tech positions today, especially those with over 50% year-to-date gains. Rotate into small to mid-cap stocks and cyclical sectors like industrials and real estate, where lower rates offer a tailwind. Defensive investors should hedge tech exposures with long-duration treasuries or gold as the VIX remains low despite macro uncertainties. Now, let's spotlight sectors. Technology led gains with Nvidia soaring post-earnings, while financials lagged. Watch for tech ETF. XLK's resistance at $184 breakthrough indicates further upside. Conversely, financials ETF XLF is vulnerable. Consider reducing exposure if JP Morgan's expense issues persist. Meanwhile, small caps thrive. Russell 2000 ETF, IWM is a buy on dips, targeting $2,600 as recovery bets solidify. Good advice makes you rich. Bad advice costs you a fortune. Listen to me. Here's your playbook. First, short term, 1 to 2 weeks. If the Nasdaq breaches 23,800, reduce tech exposure by 15 to 20%, focusing on QQQ and key stocks like Meta and TSLA. Target instruments include XLF for financials, aiming for entry around $40. Risk controls, stop loss if QQQ falls below 23,200 and reversal if 10-year yields drop below 4.0%. Second, medium term, 1 to 3 months, assuming CPI stays above 3%. Overweight small caps by 5 to 8%. Add positions in IWM and cyclicals like XLI. Maintain a close watch on Fed signals. Any hint of additional cuts could shift this allocation back. Hedge options. Advanced investors consider option collars on tech holdings. Intermediates add inverse ETFs like SKQQ for protection. Third, defensively, watch financials closely. With expense growth at JP Morgan signaling sector-wide pressures, underweight financials by 3 to 5% if XLF breaks below $38. Basic investors should consider cash positions to capitalize on future volatility. Time's ticking. Let's dive deep into today's critical market dynamics as we prepare for the next wave of earnings and economic data. We were just talking about critical market dynamics, and the biggest story isn't just the Fed's rate cut, but the massive internal clash it exposed. This is the deepest fracture we've seen at the heart of the US economy in over 6 years. For a while now, we've flagged how the FOMC's annual rotation of voting members was creating a structural split. Well, today, that fracture just went public. The situation presents a fascinating duality. On one side, you had two Fed presidents, Austin Goolsbee and Jeffrey Schmid, arguing to hold the line with no cut at all. This is the very tension we discussed previously, where easing signals were being contradicted, and now it's turned into formal dissent. At the same time, Federal Reserve Governor Stephen Miran was pushing for a much bigger half-point cut, marking his third consecutive dissent for more aggressive action. Now, get this, Miran's argument goes deeper than a simple dovish stance. He's argued that the current interest rate is about 2 percentage points above the so-called neutral rate, the level that neither stimulates nor restricts the economy. His view, based on factors like fiscal policy and immigration, is that the economy is fundamentally weaker than the consensus believes. If he's right, the Fed is already behind the curve and risks causing a sharper economic slowdown. This three-way split is the most significant division the central bank has faced since September 2019. Consider this meeting the dry run for the showdown we predicted could happen in 2026, when a new dovish chair might collide with a more hawkish rotation of regional presidents. A breakdown in consensus like this is a classic warning sign. It signals a loss of predictability, which historically foreshadows much higher future interest rate volatility. For investors, that uncertainty can increase the risk premium on government bonds and lead to the mispricing of all kinds of assets. Remember when futures markets were pricing an 87.6% chance of cuts? We warned that internal resistance could stress test those expectations. This is that stress test. But that's not the whole picture. Beyond the three official dissents, 4 other non-voting members also signalled their opposition, forecasting that rates should have remained higher. According to Goldman Sachs Asset Management, this highlights a growing hawkish bloc inside the Fed. They warn that any future cuts will now have to clear a high bar. This shows exactly how the hardened blocks we anticipated are now taking shape. So what this high bar really means for the economy is that the Fed's reaction has shifted. From this point on, they'll likely need a significant negative shock, especially in labour data, to even consider another cut. This raises the risk of a major policy mistake where the Fed waits too long to act. However, the plot thickens. One chief economist, Christopher Rupke, declared that despite the resistance, the winds of change are in the air. This battle isn't just about today's numbers. It's a major power struggle for control of the Fed's direction. The historical lesson we've discussed before, contrasting Arthur Burns' political pressure with Paul Volcker's independence, is no longer academic. Today's split brings that independence question front and centre, echoing Ellerian's warning that the Fed needs real reform. This injects political uncertainty directly into rate setting, which could undermine the Fed's credibility. And this internal paralysis has major external consequences, especially for China. A divided Fed will struggle to coordinate policy globally. This desynchronization is a leading indicator for currency volatility. A fractured committee and a higher bar for cuts could mean a stronger US dollar, which complicates China's efforts to manage its own economy. The fight for control over the economy is escalating, and the central bank's unified front has officially been broken. Speaking of power struggles, let's shift from the one inside the Fed to a new one igniting in the stars. For the first time in history, a powerful AI model is now running and learning in outer space. Nvidia-backed startup Starcloud has successfully launched a satellite carrying an Nvidia H100 GPU, a chip 100 times more powerful than any processor previously sent to space. The system is already operational, running Google's Gemma AI, which sent back its first message, "Greetings, Earthlings. I'm here to observe, analyze, and perhaps occasionally offer a slightly unsettlingly insightful commentary." But this isn't just a tech demo. It's a direct response to a looming crisis on Earth. To really grasp the significance of this, you just need to look at some startling numbers from the International Energy Agency. Global data center electricity use is projected to surge from about 415 terawatt hours in 2024 to nearly 950 by 2030. You know, that's more electricity than the entire country of Japan currently uses. the accelerating energy demand from AI is becoming a binding constraint on economic growth. If our terrestrial power grids can't keep up, the productivity gains we expect from AI could be capped. Starcloud claims orbital data centers are the solution, projecting they can operate with 10 times lower energy costs. The company's CEO, Philip Johnston, stated it plainly, anything you can do in a terrestrial data center, I'm expecting to be able to be done in space. The entire business model actually hinges on a concept called total cost of ownership. While the upfront cost of launching satellites is high, the long-term operational costs are near zero. No electricity bills, no cooling costs in the vacuum of space. That's the economic bet Starcloud is making. And the ultimate vision is staggering. A 5 gigawatt orbital data center. A single facility that size would generate more power than the largest power plant in the United States, capturing constant, unfiltered solar energy. Interestingly enough, this whole ambitious vision is only becoming possible now because of a revolution in launch costs. Thanks to reusable rockets like SpaceX's Falcon 9, the cost to send 1 kilogram to low Earth orbit has plummeted from over $10,000 to under $3,000. This dramatic cost reduction is the true enabler of this new space economy. This achievement has officially ignited an orbital data race. Here's where it gets interesting. This isn't just a commercial race. It's rapidly morphing into a new frontier for geopolitical competition. The concept to watch is orbital data sovereignty. Control over data centers in space could allow nations to bypass terrestrial data laws and gain significant strategic advantages. For instance, China is already pursuing its own 3-body computing constellation, an ambitious plan to deploy thousands of AI supercomputing satellites. This escalates the tech rivalry into a space data race. Google is pursuing its own moonshot initiative, Project Suncatcher, while other firms are targeting near-Earth orbit and even the moon. This signals a major shift, with the tech industry now looking to the skies to solve its biggest bottleneck on the ground. As a director at Nvidia summarized, from one small data center, we've taken a giant leap toward a future where orbital computing harnesses the infinite power of the Sunday. But as we look ahead, there's a critical risk to monitor. The rapid build-out of these massive satellite constellations significantly increases the danger of the Kessler syndrome, a scenario where collisions create a cascade of debris, potentially rendering low Earth orbit unusable. This is a major focal point because a catastrophic event could strand billions of dollars in assets and raise costs for all space activities.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.